index month over month. This is the Fed's preferred inflation gauge. That comes in at 0.2 on expectations, 2.1 year over year on expectations. Core month over month at expectations 0.3, and year over year a slight increase at 2.7 versus the 2.6 expected. That is, let me see if I can click on to see just if I can get the a detail there in terms of exactly the number. It is, instead of 2.6, it's 2.678. Okay, so that's the quick data dump. None of that ridiculously exciting. You got a little bit softer move on wages, little bit smidgen higher move there on that year-over-year inflation number and on the spending number, which is good for now. But what is the one thing that enables people to keep going with their spending? Well, of course, it has to do with jobs. So what I encourage everyone to do is take a look at the Challenger Job Cuts report. We're going to do it together. But I want to be really clear, because a lot of the data that we're seeing right now is either mixed or, frankly, it's strong. But we have to ask ourselves, the data that we're looking at, is it leading or lagging? What happens first? Do people spend less, or do people lose their jobs first? That's the question. And usually, people lose their jobs first because companies are cutting costs because they lose their pricing power. So in order, companies lose pricing power, they start cutting costs, people lose their jobs, and then eventually we see people spending less. And that leads to a cycle of more job cuts. Okay, fine. So we've got sort of a usual method, or maybe not method, but usual path for recessionary issues to happen with data. Okay, cool. So where do we sit on this Challenger Job Cuts report, and what does that have to do with this data that came out this morning? Well, the Challenger Job Cuts report comes out about an hour before this. And so it's fresh data. It's data that comes out today as well. It is really worth looking at because, well, some of the data just isn't that rosy, and it is a leading sign for the economy. Let's take a look at it. Job cuts fall in October, but year to date is up 4% from last year. So the headline seems benign. We get a lot of that. But watch some of the details here and see what you think. U.S.-based employers announced 55.5 thousand cuts in October, down 23.7% from the cuts 1 month prior. Oh, okay, so it's better, right? Fewer cuts from last month. But wait a minute. But it's 51% higher than the 36,000 cuts announced the same month in 2023. Usually in October, you don't get as many job cuts. And listen to the details. October's total marks the 7th time this year job cuts announcements are higher than the corresponding month a year prior. So far this year, companies have announced plans to cut 664,000 jobs, up 3.7% from the first 10 months of 2023. And here you go. Look at this. It's the highest year-to-date total since 2 million job cuts were announced in 2020. But excluding 2020, it's the highest year-to-date since 2009, when 1.19 million job cuts were recorded. So obviously, we're not in those recessionary sort of job cut numbers. But outside of COVID, it is the worst read that we have seen since 2009. So it's telling you we're not in the depths of a recession, but you're certainly trending into the direction of more job cuts. Job openings have fallen, and hiring is pretty flat at the moment. Companies appear to be in a holding pattern as we wait for the election results and the potential regulatory and market environment that follows. This is pretty common. Even though we know that historically the stock market likes to go up after an election, a lot of people get really nervous to invest before an election. They want to see, hey, are we going to get, Trumpflation? Are we going to get Kamala Harris inflation? Whatever people's perceptions are, whether it's in energy and green energy, whether it's in oil, whether it's supporting nuclear and shutting down wind. These are just examples that could affect industries, stocks, jobs, you name it. So this is not uncommon. Which industries are cutting in October? Well, Boeing helped lead some of these numbers, so you probably have to adjust some of these numbers a little bit for Boeing, just because Boeing is, I hate to say it, but Boeing is kind of that great American company that's kind of turning into a pile of poopy. It's not great. So you've got a lead here of Boeing, and maybe you have to adjust for Boeing, right? Maybe you look at the stat and say, yeah, okay, well, if Boeing's contributing, and maybe that's the reason it's the worst since 2009, then maybe that's not that big of a deal because you just have to adjust for bad data or a bad company. But as they rightfully argue here, they say major cuts from what they call bellwether companies tend to have downstream effects, which could mean more job losses for suppliers and customers in the meantime. And that's the problem. So think about that for a moment. When you look at, companies like maybe not even Boeing, just because we know they have problems. Maybe look at a company like Caterpillar. Well, what are you seeing with a company like Caterpillar? Well, you're starting to see the company miss on forecasts, miss on guidance. It doesn't move that much. I mean, the stock was down a few percent after it provided earnings. But let's be real, the stock is also still at all-time highs. It's still doing pretty well, even though it's down a few percent. Who cares? It's doing fantastically. So maybe it's not something that really matters. Maybe these are just sort of, hey, it's a bad company that's contributing or a company that is doing poorly. I don't want to say everything at Boeing is bad, but a company that's doing poorly is contributing to these numbers. And yes, there's a reduction in some of what you're seeing in the way of profits at some of these companies. But let's be real, you're going to get adjustments and normalizations after the craziness of COVID, and maybe it's just something not to worry about. Who knows? But the Challenger report, they're using the words. They're not my words. They're the ones saying worse since 2009. So, okay, let's keep going with the report and get a little bit more detail here. Retailers cut 7,600 jobs. Now, I think it's also worth mentioning as we look at this report right here. I think it's just also worth mentioning that, if I were sort of like the job cut god, and I'm not, I think that would be the worst job ever to have because everybody would hate you. It's almost like being the Grim Reaper if you're job cut god. So I don't think anybody wants to be job cut god, but let's just say for a moment you're job cut god. When do you cut most of the jobs? Do you cut most of the jobs right before the Christmas holiday season when everybody has the hopium that, hey, it's fine, we're gonna make it through, everything's gonna be okay? Is that the time that you end up cutting jobs if you're the jobs cut god? Or do you end up waiting? Do you end up trying to get through your January, basically? Do you get all the way over to January, where you've gone through the Black Friday holiday season, you've gone through the Christmas spending season, and then do you issue layoffs at that point? It's an interesting point of view. Some folks are also paying attention to. Now, that doesn't necessarily mean everything goes to poop between then and now, but it is something that some people are watching for, especially as you are starting at the same time you're starting to, how should I put it? You're starting to see a little bit of a rollover on some of those AI-related plays that people think might be propping up the economy, which isn't great, but it is something that people are talking about. Super Microcomputer is down again in the pre-market, and then we saw what happened with Microsoft. It was up yesterday, and then you're down, about 4% after they gave weaker than expected guidance on that AI profitability. And Meta told you they were going to continue to not be profitable on AI, and that their increased boost from advertising with AI wasn't actually that great. I mean, here's Supermicro just to show you it's down another 4 and a bit. Let's keep going with the report. I do want to just write down one little thing right here by this chart. I haven't done this in a while because we've been on vacation and been busy with a lot of things. But we've got a really big release coming for all of the existing courses. We're releasing a lot of new content, revamping a lot. And so on November 1, we're going to actually market that, and we're going to increase prices for the courses. You get lifetime access on those. So you get all of the new content will be included. Those prices will go up at the end of the day on November 1st as we sort of get ready to change the marketing and announce on the website at meetkevin.com. Hey, look, this is all the new stuff we're going to get, as we go into like the Black Friday holiday season and all that. We're going to be bumping prices because we're providing more value. And I just want to give you a heads up as a loyal fan before we get into this Christmas, Black Friday holiday season. If you want to get lifetime access to those courses, prices do go up at November 1st. Okay, let's keep going here. So we have, continuing with the Challenger report. And again, Boeing did contribute here, let's be clear. But retailers also cut, which I always think is interesting. The second highest for the month, let's see here. That's down about, retailers cut 7,600 jobs in October. Second highest for the month of October, but it's still down from the retail cuts announced in October of 23. So this is mixed data. Consumer products manufacturers cut 4,500 jobs in October. This is up a little bit. Healthcare companies job cuts were down 18%. Technology sector led this year with 124,000 cuts, down 24% from last year. So in some of these sectors here, retail, technology, healthcare, these are cutting, but actually not as much as you were cutting last year. Interesting as well. Media cut jobs, but also down. News, which Challenger tracks as a subset of media, cut 3,500 jobs, up 31%. Smaller category, obviously. Why are companies cutting? This is always an interesting one. Companies are cutting primarily for cost cutting. The reason for cuts this year, 144,000 cuts are due to this reason. Another are due to store unit or plant closings, while 109,000 are due to market economic conditions. Hiring plans, we have Amazon at 250K, Dick's at 8,000. For the year, employers plan to hire 750,000 new workers. This is the lowest level of seasonal hiring since 2016. Not comparing to a recessionary time, but it does show you, it's not like we're hitting new highs on some of these numbers, right? But then again, who knows? Maybe it's just a normalization. U.S. employers have announced plans to hire 659,000 seasonal workers. This is since September, which is the highest since 21. So it feels like mixed data. Let's go look at some of the tables that they give you. You have the worst job cuts outside of COVID since 2009, and you're seeing a pickup in sort of your year-to-date announcements. But when you're looking sector by sector, when you're looking at, some of the more nuanced information, you get data that's a lot less clear. It's a lot more mixed. It's not like everything is just strictly one-directional, which is worth paying attention to. And if you look at job cuts by region, I do think this is also interesting to peek at. You can look at the year-to-date job cuts. New York leading over here with some of the biggest job cuts in the East, followed by Texas, Washington, California. But then again, some of these are also some of the most populated states. So I'm not sure if that's as particularly useful. Reasons for cuts over here, we could see cost cutting and closings and market economic conditions. We've already gone through some of that data. And here are some of the hiring plans announced. Amazon, UPS, Target, Spirit, Halloween. A lot of these jobs will be lost, mind you. Spirit, Halloween, those jobs are going to be lost within a week here. And then these folks will probably go work at Amazon or UPS or Target or whatever. And those jobs will be lost again in January. But that happens every single year, and that's not necessarily an economic bellwether. So there's the full report. Do a very quick look over here. You've got, oh, this is interesting. I thought DoorDash was up a lot more yesterday. DoorDash, oh no, I guess it just slowly climbed. DoorDash up, oh no, it was actually like flat after earnings. I remember now. Yeah, DoorDash up about 4.99%. That's pretty good. Wow, look at Roblox. Roblox looks like it must have just reported. Let's take a quick look at Roblox. And then you've got Supermicro down 4.2% again. Roku's down 14.9%. Wow. eBay down 6%. Meta's only down 1%. Etsy up about 8%. Carvana's up quite a bit. That was incredible. 18%. Robinhood down almost 9%. You can see some big sways here from earnings. As a result, you've also got the NASDAQ down about 59 basis points in pre-market following a 76 basis point day yesterday to the downside. Microsoft is down about 3.5. Roblox did just report earnings. They reported revenue that exceeded expectations at $919 versus $878 mil. They've got a forecast that beats with a midpoint of about 4.355 billion versus the prior estimate closer to about 4.20 billion. More hours engaged at 20.7 versus 19.47, and daily active users also beat at 88.9 versus 84.29. Could be sort of part of the back to school. You typically see this kind of cycle, ironically, where people get into the routine of school and they're not at summer camp and they're not, doing soccer or whatever as much. And so ironically, if their kids go back to school, sometimes they end up playing more video games. Cool. Very well. So we'll see you at the Market Open live stream. Anyway, thank you so very much for being here and taking a peek at this data. We'll be at the Market Open live stream in about 30 minutes. Thanks so much. Goodbye.